The head of Germany's influential IFO said on Monday that the German economy is increasingly falling into crisis. And the reasons for that crisis are the US and globally synchronized. And that's backed up by more surveys throughout August, as well as a whole bunch of hard data. Germany was already a mess to begin with, but there had been some hope the second half of this year might see it all turn around. Instead, with the US falling into recession, those hopes have been dashed, and not just for the Germans or Europe as a whole. We know the US is in trouble because even the troubled Europeans are like, hey, whoa, that's not good what's going on in America. And we're talking about the business community over there. It's one thing when German consumers are pessimistic, quite another when highly globally connected German businesses and traders are worrying about especially the US and China, the world's heavyweights. Even the Wall Street Journal couldn't sugarcoat the message like it normally would. Its headline from earlier this month simply stated, German economic expectations nosedive as global slowdown fears bite. They aren't simply fears, though. We've got data and also markets. In Germany's government market in particular, the bull steepening on that curve continues as both a warning and a timing signal. And the curve had been right back in late 2022 when it went into inversion, warning everyone that it was going to get dicey over there. And now it looks like it's right coming out of inversion because, as the IFO guy said, Germany may be in a crisis, but it's not just a German crisis. We look at the German Bund curve, and bull steepening, just so we remember, is where short-term rates go down farther and faster than they do at the long end. And that has definitely been the case over in European government bond markets, Germany's in particular. Since the early part of this month, the liquidations and financial volatilities to start August, German rates went down like everyone else did, but they have come back only a small amount and have traded in a very narrow range with a somewhat noticeable bias at the short end. So the bull steepening continues even though German rates have been mostly sideways since the big flight to safety earlier in August. And as of today, the 2-year German Schatz was 238, the 10-year Bund at 226. And just to remind you, the European Central Bank's policy rates, the MRO, the target, the midpoint, is all the way up at 4.25%. And that's after one rate cut already from the ECB. The deposit rate floor is at 375. Here we have the German 2-year down at 238. More importantly, perhaps, especially as a timing signal, the German 2-year, 10-year spread. That one narrowed to 8 basis points, which is the narrowest yet ever since it inverted way back in 2022. That's the 2-year going down faster than the 10-year. That spread had been as inverted as 21 basis points on August 2nd, when everything really started getting going there, the US recession more than fears, and had been inverted by 29 basis points way back July 18th. The 2-year, 30-year spread is now uninverted in Germany. That's now plus 11, so that's gone into real bull steepening territory there. And it had been inverted as late as August 6th, and it had been 17 basis points inverted back in the middle of July. So you see a 20, almost 30 basis point swing in the 2-year, 30-year spread. It's almost like the German market is saying exactly what the IFO guy just did. That the economy, which has already been in trouble for a very long period of time, an undeclared recession since the fourth quarter of 2022, somehow it's actually getting worse, defying all expectations for a recovery to begin in the second half of this year. At least that's the official stories I'll get to just a bit. Essentially, Germany, the European economy, were supposed to be picking up here. Instead, what we're picking up are only warning signs from every direction, only starting with the bond market. The bull steepening is not a good sign. It's a sign that the market is expecting rates to go down relatively quickly, relatively near term, and to stay that way for a prolonged period of time. And those are not good scenarios. And the European Central Bank, which might be cutting rates in September as the second rate cut in what's likely to be a series, that's not a good sign either. As I keep talking about and pointing out, rate cuts from central banks are a bad sign. It's them saying we see the weakness too. Rate cuts aren't going to do anything about it. They're simply a response to the same thing that markets are pricing. And now we're seeing in surveys, at the very least, all across Germany and Europe. So what did the IFO guy say? Who is this IFO guy? Well, what he said was essentially that the pickup that we thought was going to happen in the second half, Germany's commercial sector, Germany's trading and professional sector, they don't see it happening. In fact, what they do see is, well, here's what he said. The German economy is increasingly falling into a crisis, according to Clemens Fust, president of the IFO Institute. And the IFO Institute and its indicators, the business climate indicator, are widely followed in Germany because of who they survey. Again, as I said, professionals in the real economy, commercial agents and whatnot. And the IFO continued from there. In manufacturing, the index fell considerably. Companies were significantly less satisfied with the current business situation. Expectations fell to the lowest levels since February. Companies once again reported declining order backlogs, huge red flag there. The situation for investment goods manufacturers in particular is difficult, and even in the service sector, the business climate deteriorated. This was due in particular to skeptical expectations. In addition, the current business situation worsened somewhat. And according to the numbers, the business climate indicators that the IFO puts out, the situation index for the business climate indicators had been at a multi-month high back at April at 88.9, which raised these hopes that Germany was emerging from its 2-year-long slump, or nearly 2-year-long undeclared recession. Call it a slump if you want, but it's really a recession. So the business situation index had been up to 88.9, but that's not unusual. We see this almost every year, certainly in the post-pandemic period. That's the same thing we see here in 2024. Since that 88.9 in April, the situation index has been down 4 straight months to now 86.5, which is its lowest since July of 2020. That's consistent with Germany suddenly realizing we're not getting out of a recession, and therefore, as the IFO president said, it's starting to look like a crisis because after this long with this much weakness, somehow it's now getting worse. Yeah, that's crisis level proportions. We're seeing that in the markets as well as the reasons why that's the case. It's not just about Germany. Germany, we pay close attention to Germany because it's the biggest economy in Europe, sure, but it's also a global bellwether. And even mainstream economists are starting to get the message that this is not Germany's year. Indeed, hopes at the start of the year that the economy would swing upward again have disappeared, mainly due to a weaker global economy, but also because of fears of a cooling U.S. economy, continued geopolitical tensions, and domestic policy uncertainty, at least according to ING's economist Karsten Brzezinski. The German economy seems to be back where it was a year ago. Again, these seasonal patterns. The growth laggard of the Eurozone with little signs of an imminent improvement. That's what he said in a research note. And all of the data, like the markets, continues to bear that out. Whatever hope there was for a seasonal or beyond seasonal upswing into a recovery early this year has been thwarted by a combination of factors, starting with the United States and the global economy. It's not just the IFO. Another widely followed, widely considered survey in Germany, the ZEW. And it's widely followed and widely watched because of the same reasons as the IFO. It surveys commercial participants in the economy, professionals. And the ZEW had been even more optimistic about prospects this year in Germany than the IFO had. The ZEW sentiment survey soared, though the ZEW tends to do that every time the ECB is about to engage in some form of accommodation. Whether it be QE or interest rate cuts, those always make commercial professionals happy, even if it doesn't have any impact on the actual economy. So they're happy about the potential for the future, at least until they see how it's not turning out to be what they hoped. So even the ZEW's sentiment index started to roll over in the middle of the year, and then for August, the number actually plunged. It plunged by the most since 2022. The sentiment index fell to 19.2 from 41.8. That's a sharp decline. And the ZEW sentiment index for Europe as a whole was also down pretty substantially. The current situation index, that one dropped too, to minus 77.3 from minus 68.9, which shows that the ZEW survey respondents, their opinions of the current German economy never really turned positive, much more than really pessimistic at all during this year. So it was mostly future hope that maybe, just maybe, there'd be enough positive factors to get Germany out of its 2-year slump. And instead, all of that is disappearing. Why? Well, according to ZEW's president, Achim Wambach, economic expectations for the euro area, the US, and China deteriorated markedly. Consequently, the expectations for export-intensive German sectors were particularly affected. It's likely that economic expectations are still affected by high uncertainty, which is driven by ambiguous monetary policy. I always have to say that. But mostly disappointing business data from the U.S. economy and growing concerns over an escalation of the conflict in the Middle East. I have to throw that in there. It's not ambiguous monetary policy. It's not really about conflict in the Middle East, which is already calming down. It's the middle one. If the U.S. falls into recession, if the U.S. hasn't already fallen into recession, but if the U.S. falls into recession, what that means for the rest of the global economy is absolutely huge. It's huge and not in a good way. So the ZEW, like the IFO, says Germany's a mess and it's not looking better. And one of the reasons, the key reasons why it's not looking better, China as well as U.S. recession indications. These numbers are further backed up by the PMI reports from S&P Global, Hamburg Commercial Bank. For the preliminary flash data for the month of August 2024, they showed the same things that we've just been talking about. That Germany's economy, which showed a little bit of a flash of hope, a flash of promise earlier in this year, has instead been plagued by its own inability to make a recovery happen, as well as these external factors, globally synchronized weakness, U.S. recession prospects that are no longer just prospects or fears, actual negative impacts that we can see in the survey data. According to S&P, the composite for Germany fell to 48.5 for August, which was a 5-month low. The services index for Germany fell to 51.4, which was a 5-month low. The manufacturing index, which was never good at any point, any time over the last couple of years, even that one fell back to 42.1, which was, say it with me, a 5-month low. So there was a little bit less pessimism, a little bit less of a contraction in the German economy, according to S&P Global's figures earlier this year, consistent with the seasonal pattern. And once again, Germany's rolling over into the summertime, and the increased pressure from the U.S. economy and the globally synchronized recession. What S&P Global had to say about it was, the worsening performance of the private sector owed to weaker underlying demand, no surprise. Total inflows of new work fell for the 3rd month running and to the greatest extent since February. So there was a bit of an upswing, which was really less of a contraction, and now just falling right back over again at the worst possible time. Service sector new business barely rose in August, while goods producers noted the steepest reduction in new orders for 9 months, amid reports of customer hesitancy and weakness in the construction sector. The drop in total new work partly reflected weaker demand from abroad, with services firms and manufacturers alike recording deeper declines in new export business. Globally synchronized. Germany, Europe, they were already in trouble. And now comes the rest of the world synchronizing up with Germany and Europe in trouble rather than the other way around. This was supposed to be the year of global reflation, led by China, led by the strong and resilient U.S. labor market, and both of those have completely wasted away. The U.S. labor market now has weakened so much that it's got the Federal Reserve talking about rate cuts in series of them. Jay Powell at Jackson Hole. China's just a mess, and that was never coming out to begin with. So Europe was looking for the rest of the world to globally synchronize into recovery, at least reflation, and instead the rest of the world is falling off, and Europe has already been in recession. So according to the IFO guy, it's hard not to see this as something of a crisis, at least for Germany, but not just specifically Germany. In terms of hard data statistics from the German government itself, we've got export and import figures, but focusing on the export numbers as far as June, that's the latest data that they've updated. There's been a sharp decline in German exports, especially May into June. And the key reason why is, well, here's what the German government said. Most German exports in June 2024 went to the United States. After seasonal and calendar adjustments, Exports of goods to the United States were down 7.7% compared with May, with the value of exports to the US dropping to 12.9 billion euros. And when we look at it by volume numbers, it looks even worse. So adjusting for currency exchange translations as well as prices, exports to the United States from Germany were down almost 15% year over year. That's compared to June 2023 by volume. 15% less stuff being sent, and the number in terms of euro was 6.4% decline. So down 6.4% in euro terms, down 15% year over year by volume, and that was after falling almost 9% year over year by volume in May. So Germany experiencing weakness because the US started to head toward recession around March and April, like we see in a whole bunch of data here in the US. So while the export numbers back up everything that we're seeing in these survey results, the German central bank, the Bundesbank, says, well, we're optimistic about the way things are going. A couple months ago, the Bundesbank put out its forecast, and they forecast still the turnaround for the German economy. Here's what it said. The German economy is slowly regaining its footing after a roughly 2-year period of weakness. It's actually undeclared recession, according to Bundesbank's current forecast for Germany. The German economy is extricating itself from the period of economic weakness, according to the Bundesbank's president. Not only will private consumption gradually pick up, but export business will also improve again from the second half of the year. Against this backdrop, industry will grow more strongly again. So they said that a couple months ago, and then all the data went in the exact opposite direction. So the Bundesbank got to be more positive because there's nothing they like more than their own work. A few rate cuts after a 2-year-long slump, why not? That'll certainly fix the situation. Well, over here in reality, things are going in the other way, and the other way in far more serious fashion. They've already been in an undeclared recession, as I keep saying, for almost 2 years, and now the German bond market is saying it's actually getting worse, not in the future, sometime down the road, but here and now. And that verdict, the bull steepening on the German curve, is being validated by a whole bunch of data for Germany, but also for outside of Germany, and how Germany is a reflection of these global conditions. Especially, keep saying U.S. recession, U.S. recession. So I don't know if Mr. Fust is right about a crisis, but if there is one, this is exactly what it would look like from all of these different angles. And one of those angles, one of the biggest ones, includes the U.S., as the Europeans and the Germans are already looking at their own situation, not liking what they're seeing. But then they look at China and don't like what's going on there. And then they look at the American economy, they don't like what's going on there. So globally synchronized is not just a slogan. So the world economy is becoming more and more synchronized by the month, and not in the way that Germany's central bank or the European Central Bank or the Federal Reserve had anticipated not all that long ago. Instead, we're seeing recession signals pick up in every direction, and they continue to show globally synchronized downturn and worsening conditions from everywhere. Even the Federal Reserve knows the U.S. economy is in trouble. That's why Jay Powell at Jackson Hole spent so much of his speech trying to sell you on the inflation story. Talked about that with Steve at the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.